Hey everyone, welcome back to Corporate Decoder. Today, DWS Emerging Markets Fixed Income Fund just filed its semi-annual shareholder report, and I am seeing some interesting moves in how they are investing your money. Quick note, this is not financial advice, just my take on public filings for educational purposes. The fund's portfolio looks like it is really leaning into emerging markets debt, and I want to break down how that actually plays out for investors. So this report covers the 6 months ending the 30th of April 2026, and it gives us a really good look at where this fund's money is going. It is a non-diversified fund, which means it can put a lot of its eggs in fewer baskets, and that can lead to bigger gains, but also bigger risks. First, let's talk about costs. For class of shareholders, the cost of a hypothetical $10,000 investment over these 6 months was about $58, which works out to 1.16%. For classes shares, that cost shrinks to $46 or 0.92%. The institutional class shares are even cheaper at $46 or 0.92% as well. While these are percentages, that dollar amount can add up, especially when you add it to whatever potential market gains you might see. Now, let's dive into some key numbers. The fund's total net assets are around $48.5 million. They hold about 110 investments, and their portfolio turnover rate, which is how often they buy and sell assets, is a pretty high 103%. This means they are actively managing the portfolio, likely trying to capitalize on market shifts. The effective duration, a measure of how sensitive the fund is to interest rate changes, is 6.9 years. That means for every 1% change in interest rates, the fund's value could swing by about 6.9%. This is where it gets really interesting. The fund is heavily invested in bonds, making up 92.8% of its assets. They're putting a massive 65% into sovereign debt, meaning they are lending money to governments. Another 22% is in government agencies and 6% is in supranational organizations, like international development banks. Cash and equivalents make up 4%, and surprisingly, only 1% is in treasuries. Corporates make up 0%, which is a pretty strong statement about their strategy. When we look at credit quality, the fund holds a significant portion, 36% in BBB-rated bonds. That is considered investment grade, but it is on the lower end. Then you have 30% in BB, which is considered speculative, and 19% in B-rated bonds, also speculative. This shows a clear appetite for higher risk, potentially higher. Reward debt, only 3% is in AAA, AA, and AA rated bonds combined, and 3% is not rated at all. Geographically, Mexico is their biggest bet at 11%, followed by Angola at 8% and Nigeria at 7%. Brazil, Turkey, Chile, Dominican Republic, South Africa, Hungary, and Uzbekistan also feature in their top holdings. The remaining 40% is spread across other countries. This is really an emerging markets play, focusing on countries that often come with higher political and economic risks, but also potentially higher returns. Let's look at some of the actual holdings in Angola. They have several bonds maturing between 2028 and 2035, with interest rates ranging from 8% to 9.875%. In Brazil, you see bonds with yields from 5% to 6.625%. They're holding debt from countries like Burundi, Chile, and even some corporate debt from China. For example, they hold Republic of Angola bonds with an 8% coupon maturing in 2029. The cost for this batch was over $1 million, with a current value slightly higher. They also hold some corporate debt in China, including from Country Garden Holdings Company, limited with a 5.125% coupon maturing in 2027. It is interesting to see these specific companies alongside government debt. Looking at the statement of assets and liabilities, the investments are valued at around $45 million. They also have a receivable for fund shares sold and interest receivable, which is pretty standard. On the liabilities side, there are payables for fund shares redeemed, some accrued expenses, and notably, an unrealized depreciation on forward foreign currency contracts of over $2,000. It is also important to see how the different share classes are doing. For Class S shares, the net asset value per S share is $7.68. Class S shares are valued at $7.67, and institutional class shares at $7.66. These numbers are very close, which is expected since they represent the same underlying fund assets. In the statement of operations, we see the income generated. Total income from interest and other sources was about $1.7 million for the 6-month period. Expenses, including management fees, administration fees, and other operational costs, came in at around $307,000 before reductions. After expense reductions, the total expenses were about $234,000, resulting in net investment income of over $1.48 million. Now, the really volatile part, realized and unrealized gains and losses. The net realized loss from their investments was a pretty significant $2.07 million. Futures contracts also contributed a loss of about $54,000, though forward foreign currency contracts actually brought in a gain. However, the change in net unrealized appreciation on investments was a positive $1.98 million. So, while they took a hit on realized losses, the unrealized gains on their holdings helped offset that. Overall, the net gain or loss for the period was a slight loss of about $160,000. Looking at the statement of changes in net assets, the fund saw an increase of over $1.3 million from operations after accounting for gains and losses. However, distributions to shareholders were around $1.96 million. When you factor in share redemptions, which were over $5.6 million, the net assets actually decreased by about $3.3 million over the 6 months. Let's look at the per share data for class of shareholders. The net asset value at the start of the period was $7.76, and it ended at $7.68. The total return for this period was 2.62%. For the full year 2025, the total return was a much stronger 13.09%. The ratio of expenses after reductions was 1.16%. Indicating a somewhat higher expense ratio compared to some other funds, but the net investment income yield was a healthy 5.60% annualized for this period. For Class S shareholders, the story is similar. The net asset value per S-share went from $7.7 to $7.67, with a total return of 2.67% for the 6 months. Their expenses after reductions are a bit lower at 0.92%, which is attractive. Institutional class shares saw a net asset value per S-share go from $7.76 to $7.66, with a total return of 2.67%. Their expenses are also 0.92%, aligning with Class S. The notes to the financial statements provide crucial context. The fund operates as a non-diversified series of DWS Globally International Fund. Incorporated, they follow us generally accepted accounting principles, and management estimates are used, meaning actual results could differ. When it comes to valuing securities, the fund uses a 3-level system. Level 1 is for quoted prices in active markets. Level 2 uses observable inputs, and Level 3 relies on unobservable inputs, meaning the fund's own assumptions. Most of their bonds are valued at Level 2. Indicating they are not always trading in actively quoted markets. Notably, some Chinese company holdings are valued at Level 3, suggesting more subjectivity in their valuation. The fund also engages in securities lending, which means they lend out their securities to financial institutions and earn income on that. They require collateral to back these loans, and as of the 30th of April 2026, they had nearly $1.14 million in securities on loan. The cash collateral from these loans is invested in affiliated money market funds. They are also actively using derivatives, specifically futures contracts and forward foreign currency contracts. They use futures to manage interest rate risk and forward contracts to hedge against currency fluctuations, as of the 30th of April 2026. They had unrealized appreciation on futures contracts of about $30,000 and on forward foreign currency contracts of around $2,000. These instruments can amplify gains but also losses. Finally, the report includes a section on the board's considerations for renewing the investment advisory contract. They reviewed everything from the fund's performance, fees and expenses to the quality of services provided by DWS Investment Management Americas, Inc. The board noted that the fund's performance, particularly for class of shares, was in the top quartiles compared to its peers over various timeframes, and it outperformed its benchmark. They also saw that management fees, when considering administrative fees, were lower than the median for similar funds. Expense limitations were put in place to keep total operating expenses competitive. The board concluded that the fees were reasonable and that the continuation of the agreements was in the best interests of the fund. Looking at this filing, the WS Emerging Markets Fixed Income Fund is definitely taking a strong stance on emerging market debt. They are comfortable with higher risk investments, aiming for potentially higher returns. The significant allocation to sovereign debt in countries like Mexico, Angola, and Nigeria, combined with the credit quality leaning towards speculative ratings, highlights this aggressive strategy. While the realized losses are concerning, the unrealized gains show that some of their longer-term bets are paying off so far. The question for investors is whether they can consistently navigate the volatility inherent in these markets. My biggest concern is the high portfolio turnover and the heavy reliance on speculative-grade debt. It means the fund managers are making active bets. which can be great in a bull market but very risky when markets turn. The research tools I use to track these filings are linked in the description below. They help keep this channel going. That is my take. Stay decoded. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description.